That's
So
fascinating.
I think your history and knowledge is something very unique, right? And you know that beginning because not a lot of people had the opportunities you did. I want to see from your point of view, because Nathan and I talked privately before meeting you about some woman who wants to learn about the secondary space. What was your understanding before you met the secondary space and then after?
I had no idea that even existed. Like, what do you, I mean, I remember when I first started, people would be like, secondary. I'm like, secondary to what? Like, what are you talking about? What is a secondary market? I mean, and I worked at the Wall Street Journal. I read financial press all the time, but it still was. And then, but what would that have to do with housing? And then I think it took me all these years I've been in it. It wasn't until very recently that I really codified in my own head how much government had gotten involved in origination and
Yeah.
how, I knew they'd squeezed out private, but I don't think I've thought through those implications. I just knew it had happened, right? And I think so often we think that if it's going into the government's hands, it's going to a safer space.
Mm-hmm.
No. That is not. We are now at a much less safe space than we were actually, in my opinion, in 2008.
And we'll get into that in a minute. I think
Interesting.
that part is really interesting to me because I watched some of your YouTube videos, and it was scary what you were saying, and it made a lot of sense, right?
Yeah, I probably
So you
shouldn't be
came
saying
to
on LinkedIn, but
you came to DME, right?
I did.
What's
We
your
had talked.
reaction? Yeah, go ahead,
We
Nathan.
had talked a little bit before that, and you're trying to get a sense of like how big the secondary space is, and
Yeah.
that's really hard. So I don't know
Mhm.
if you were there on the Saturday morning when we talked about seller finance, and Fred put up his slides and showing just, I think, oh dang, I'm going to get it wrong, but I think it was just last year, 2023. It was something like 23 billion.
23 billion. Yeah, I saw his slides. I actually featured them, Nate, in a
Yeah.
in a Substack. Yeah, I saw those, and I think that's actually much smaller because I think they're just using what they captured in the MLS.
Yes.
So we know that this is happening outside the
Yeah.
MLS.
Yeah.
And so
And
I think, yeah,
that's just seller financing.
right.
That's
Right.
not even
That's
counting
one
all
little
the
component.
yeah,
Exactly.
all the loans that Dave and I bought
Yeah.
from banks over the last 10, 15 years.
Yeah. So you got the DME and you realized the secondary market. What was your takeaway from that?
Well, I think the biggest learning, and this is where, again, sometimes we can just be such useful idiots, right? When we assume things. My biggest learning was that the hedge funds that had participated in those single family loan sales that I had worked ever since they started in 2015, worked on side letter exceptions. I mean, I worked those things all the time. And I saw, okay, you can't foreclose, you can't do this, you can't do that. But what I didn't even think they would even make possible is that those could be sold. And that was just like a whoa moment for me. And I was just like, holy cow. That's because I had always worked with the big guys like Goldman and Morgan and all these people that were playing in that space. I had no idea they were selling them. Like I had no idea. And then, I think too, when I went back to go look at all the single family loan sales reports, the fact that they've stopped reporting, I felt that was kind of, you can't get a lot of reporting on successful exits. I mean, it feels like, I think they understand how bad their programs are, the GSCs, the agencies, the administration. And so I think they probably don't even want it to be known how more effective that could actually be, resolved in a private market. And so I think that might be why they don't talk about it very much, but they certainly understand it.
Sure.
And I have a very interesting theory about what's actually going on right now in the treasury markets and what they're trying to affect, which is something very similar to HARP. But I'm sure we'll get there if we have time.
Yes. So let's learn about the data right now that you're seeing in the housing market. We've all heard the fact that the housing market still has a shortage, and I think people use the idea that they're able to sell a house very quickly because it's not a lot available. What is your information telling you?
Days on market for the 80 plus cities I track right now are at 50. Like the housing market is frozen. And anytime they talk about bidding wars again, poke holes, ask questions. What exactly are there? Because they're just trying to create FOMO. Like, for instance, a couple of months ago, when we saw those rates drop at the end of last year, a couple of months ago, oh, Dallas, it's hot again. I was like, calm down, everybody. I was just in Dallas. Like, it is not hot. Maybe you have one neighborhood where everybody thinks they want there and there's only one house for sale, but I guarantee go back in a couple of months, there's going to be 3 or 4. Sure enough, year over year, price declines in Dallas. I mean, we are seeing so much narrative right now because everybody that is currently in positions of power believe that the wealth effect drives consumption, drives GDP. And so we want everyone to feel much, much more wealthy or wealthier than they are now. And so if you have any concerns about your equity in your house, you are not going to feel wealthy. And so there is a lot of effort out there keeping this machine running. And a lot of it happened on the back of new homes last year. They could affect those rate buy downs. They could then do, price cuts and all kinds. They'll give you, they'll give you your washing machine, your refrigerator, all that kind of good. They'll pay your HOA fees for a first year.
Yeah.
And so the builders really carried the market last year, but they're not in a position that now they have so much inventory over 9 months that they have to get it through the system because they're production oriented. They're not like a single family seller that's like, could wait a couple of months or I'll go rent or do something, it's not the same thing. And so that we saw an historic flip in June. We'd actually seen it in May where new home prices were actually less than existing home prices. When they revised the data, it flipped again, but in June it happened again. And so what we're about to see, and that's only happened 2 other times in the last 25 years, June of 2006 and June of 2021.
Wow.
Anybody remember what was going on back then? Yeah. So, we are in it and, we just broke pierced the veil of seasonality here. If you're looking at combined sales from an existing and new home sale perspective, meaning on an absolute basis, this is not adjusted for population. On an absolute basis, this June and was the lowest sales in the last 25 years of data in a June. And the housing market has a very specific season and it always peaks in June. This is the first time in those 25 years that sales did not increase from May to June. Now, something else could also be happening though, and that's things in your space and they're not being captured in those official numbers. But I think directionally, we know that like the markets are frozen pretty much right now. And because buyers are just like, yeah, I know what you tried before and I'm just not having it. And I think even if they do get there, they get down at the closing table and they see that insurance bill and they're like, whoa, no. Like we had the highest, Redfin said, we had the highest cancellations they've ever seen last month. And that's existing home sales. You often have cancellations in new homes runs about 12 to 16% historically, but cancellations in existing home, that to see a record there. So I think the consumers got real excited in the spring with the stock market and they looked at that and said, we must all be getting those that could transact, those in the top 20%, because our consumer is dead on the bottom 80%. But then as things started to wobble at the end of June with the political events that have occurred, and suddenly we're all like, wait, are we being lied to? And I don't want to discuss politics, but I think everybody kind of woke up and said, wait, what? Yeah. And I think in June, you could see that in mortgage delinquency, we had a 13% increase month over month. We don't see moves like that. We don't. And 30 plus guys, and I'm screaming like a crazy lady, but you're from this business. So you understand what I'm saying. When I say it to other people, they don't. Yeah. Over 19% increase month over month and 30 plus. And they tried to say, Black Knight tried to say it was calendar driven because the month ended on a Sunday. Well, hold on, guys. The month ended on a Sunday in March. Yeah. And delinquency went down. Also, I've worked at mortgage servicers. You effective date those payments. Yeah. And if you have habitual late payers, they absolutely know if a holiday is coming up or whatever reason, they've got to get that payment in so it doesn't ding their credit. They know this. We live in a country that is obsessed my
Yep.
credit scores. And so that's kind of like a lot again, but where home sales are in the, down the drain and delinquency is increasing.
Are
And
you
you're
seeing?
seeing,
Go
oh, go
ahead.
ahead, Nate. No, you
I
go
was
ahead.
just going to ask if you're seeing any of these in like specific markets. Is this, I mean, nationwide, obviously, but specific markets?
Oh, it's always the South. And as a Southerner, it is just, when I was doing the tour of Austin and Nashville and Charlotte, and I was just like, this is like reconstruction all over again.
Mhm.
The carpetbaggers coming in, just whatever they can get. But it's the South. It's Louisiana, Mississippi, Alabama, but it's increasing in all of these places.
Mm,
And so two, I think we don't often, like, for instance, you can look at Austin and delinquency is not that bad there.
Mhm.
However, most of the people that bought homes in Austin don't live in Austin.
mm,
They don't. I mean, there was
gotcha.
just so much speculation. They
Mhm.
live somewhere else and they bought this sight unseen. And I mean, I cannot, the amount of vacancy out there, guys, is just so shocking.
Yeah.
You're overwhelmed. And so there might not be for sale signs up today, but just on my road alone, where I live, when I first, like 6 months ago, there was one. By the way, it's still for sale.
Mhm.
6 weeks ago, another one showed up. And you could tell it was like a work from home office. I looked it up. And then a week after that, a for sale by owner showed up. And
Mhm.
then two boats, lawnmowers. I mean, the consumer they're at the end of their rope. The top 20% have been doing just fine, but they're getting a little offended. They don't
Yep.
want to go and spend $20 for a martini that tastes like crap and takes an hour to get there. So they're going to
Yeah.
start pulling back for different reasons. Additionally, these political events and what happened in the markets are also going to make them more skittish. And so you're seeing pressure at the top of the K and the bottom of the K too. But what we saw in the University of Michigan Consumer Sentiment Survey is that historically your lower tier and your mid tier don't have the same sentiment. Those have now aligned. And so really all that's left is that top 10% and they're
Mhm.
offended. They're going to start backing away.
So isn't that what the Fed is trying to